Welcome to day 20 of our QuikStrike video series. Today we are going to cover pricing sheets OTC sheet, and that will conclude our pricing sheet menu video section. Like we do every video, let's get started with just a little bit of review of where we are. Currently we're on the market dashboard product overview page. This is our first landing spot when we log into QuikStrike for the first time. Today, our default product is in the FX category. It's the Euro currency, and as you recall, I can go over to the My Account section into my preferences and change that as I desire. And I've been switching that up throughout the video series. So let's get started with our pricing tools. Let's go take a look at our OTC sheet. We've looked at this a little bit in some other videos, I believe, but today we'll take a little bit more formal look. So basically what you're going to see here is for every contract that is available within a product, we are going to create these delta-based pricing sheets. And we call it the OTC pricing sheet, and we probably could call it delta pricing sheet. But this typically is how, the delta is typically how the OTC market will look at things, or one way that they look at things. Not, typically might be the wrong word, but one way that they look at instead of strikes, they look at the delta of an option. So, and it allows them to sort of think about where volatility is from a much more uniform standpoint when they're talking about the vol skew itself. So it's sort of the 20 delta, 25 delta. The strike's going to change as the underlyings go up and down, but that delta is always sort of an anchor for people to think about in terms of what that level of volatility is. So we've created these OTC sheets for your review. So basically what we've done is we will calculate deltas for all the different strikes until we find something that fits. So if we just take the example here, let's go down to the at the money since it's in yellow, and I'll highlight underneath that as well. So in order to find the 50 delta, we had to interpolate a strike of 114 that's between the listed 110 and 115 strike. So the perfect 50 delta is the 114 strike, which is not a listed strike, but this is telling you exactly which two strikes we used to get that interpolated strike. And this goes for everything from the 5 delta to the 45 delta, right? So we have talked a lot about risk reversals or combos or squashes, whatever you happen to call them, and that's typically when you're buying a call or selling a put and selling a put against it. So again, each people tend to think of it put minus call minus put. We call it call minus put, and we call it a risk reversal in QuikStrike. So this will let you quickly see what the 15 delta risk reversal is valued at. So what we have here is we have the price of both the call and the put for the 15 delta, and then we have the risk reversal value. So what we're seeing here is we have 0.002 and we have 0.002 here for the put. So our call minus put value is 0. And then we also do a put minus call over here, and you'll see it's 0. So let's push out on the curve a little bit. Let's go to June and take a look. So now we have our 15 delta call is 005, and our 15 delta put is 006. So our risk reversal value is minus 001. Okay, so same thing over here. It's 6 minus 5, which is 1. So we're pricing up the theoretical 5 delta through 45 delta put, and then 45 delta call, the 5 delta call. So we're giving you the prices for all those in the call and put sections, and we also pre-calculating the risk reversal and butterfly values, and then we give you the Greeks for the individual theoretical delta strikes. Okay, so and then what we're seeing here is these are the strikes that were utilized to create this theoretical 15 delta, and you're going to find sometimes they fall on a listed strike, okay? And then these are the volatilities that we have for both the upper and lower strike, as well as the theoretical volatility associated with that theoretical strike. And the usefulness of this page comes when if you actually want to execute a risk reversal, a combo or a squash, again, depending on what you call it, you can go to this page and see, well, what are my options in terms of which strikes I can use to do this. So in this case, if we look at the 20 delta, the listed 175 is very close to the 176, so we might want to start there. And then if we go to the 20 delta put, we see that we're sort of between the two strikes here, so we can choose which one we want to use. Okay, so we can get pretty close to a theoretical 15 delta risk reversal just by doing the 175 minus the 165 or the 65 or the 60 put. Okay, so that's how you should really use this page. Like I said, like you see, this pricing sheet page is underneath this menu item. Okay, but we're pretty certain that we're going to also move a copy of this into the standard sheets underneath the advanced. I'm going to show you real quick underneath this advanced section, just to make it sort of all in one place here. So we'll keep this here for a while, probably for an extended period of time until people get comfortable with the move. And we may not swap it in there right away, but we're planning on doing that. So that is the OTC sheet, the Delta Strike sheet, however you want to think about it. And again, remember, you can click on these symbols and futures prices and get the information about that expiration, so you can not have to jump around and looking at different places. So this is a quick one today. Again, we covered the pricing sheets OTC sheet, and we're glad that you can join us. So we appreciate you taking the time to watch a video with us. Have a good one.